5 steps to scale your startup. Welcome, everybody. We're going to start, we're going to wait a few seconds so that everybody can join. Just waiting a few seconds to start our event today. Five steps to scale your startup. Welcome, everybody. Thanks for joining our webinar today. This is an event presented by InvestHorizon in collaboration with HBAN, the European Business and Innovation Centers Network, and CorkBIC. My name is Perrine. I'm project manager at the HBAN. HBAN is a partner of EU project InvestHorizon. InvestHorizon is an EU program financed by the European Commission in association with Eureka in order to facilitate Series A funding for selected deep tech companies. Make sure to visit our website, www.investhorizon.eu, join our community, and be up to date with all our activities. We are continuously uploading free of charge online classes and webinars dedicated to financing and entrepreneurship in the tech sector. Our webinar today is dedicated to Scale Up and Series A B funding. This is the third event of a larger series of online events dedicated to financing. They are all available for replay on the platform, so don't hesitate to go on our community. Our guest speaker today is Michael O'Connor. Welcome, Michael. Michael is CEO of CorkBIC, a business innovation center located in the southwest of Ireland. The company has specialized in high-tech businesses involving international growth. Michael and his team at CorkBIC have a strong track record of selecting and guiding successful startups over many years and achieving good exits. Michael is also the founder of the International Security Accelerator. He created and runs a regional business angel network. Michael is a board member of several private and public companies, including the HBAN. So before I give the floor to Michael, we'd like to know who is in the audience today, and we'd like to ask you to answer very quickly these 3 questions popping up on your screen. First questions, who are you? An entrepreneur, an investor, or an innovation professional? Thanks for answering the question. A few seconds. Okay, I see that 83%, we have, 85% of you are entrepreneurs, no investors, and 18% of the participants are innovation professionals. Second question for the entrepreneurs in the room. If you're an entrepreneur, are you a startup in the fundraising process, a startup having raised the first round and seeking for more, or a startup with no experience in fundraising? Give you a few seconds to answer. Okay, so 43%, 42% startups in the fundraising process, 42 having raised the first round, and 17 no experience. Third question and last question to the audience. Are you operating, you entrepreneurs, are you operating in the fields of light tech, hard tech, or other? Give you a few seconds to answer. Okay, the majority of you are saying that they are in hard technology. Okay, thank you all for answering. Just a few words about the session. So Michael will be presenting for 20 minutes. He has a guest speaker. Then we will have time for questions and answers after the presentation of Michael. So you can start typing your questions in the window. And that's it. I wish you all a good session. Michael, you have the floor.
Thank you, Perrine. You're an excellent chair. And so we'll get going. Interesting things to start with. If you could put the slides up, Perrine, that would be great. Interesting things. Over half of you come from a high-tech background, working in the high or hard tech space. And also nearly half of you have raised some funding already, and so you're looking towards Series A. And I think that's really good. So that gives me a kind of scope. We operate in this area, we're very comfortable, and we work with growth companies. We've worked with many hundreds of companies over the years, and in the last 5 to 10 years, we've been working with deep tech, from cybersecurity to AI to medical med tech at a drug or at a implant level. In recent years, and we also raise funding for them all the way up to Series A and through that. So, and we sit on some of their boards. So we have a lot of experience. So we're going to talk about the 5 steps that you have to get right in order to scale your startup. Many people we see have got the bones of a business. It's not focused. It doesn't have enough traction. It doesn't have repeatability. And as a result of that, they struggle to raise Series A. Series A, we're saying, in the European context, is probably €1 million investment, cash investment upwards. And so they struggle to raise the Series AB level. And it's really critical to do that because it can't scale, or it takes too long. I sat with one of our clients this morning who has built a business, and it's doing 25 million a year annual recurring revenue. It's a software as a service business, a SaaS business. He's got 300 people working for him. And he's got no debt, no equity, and he's growing, but it's taken 10 years or more to do. With accelerated financing, that could have happened a little bit quicker. So yes, you can build fantastic businesses, but you've got to de-risk it with equity investment. So to kick off, the 5 steps, Penny, if you could change the slide. Yeah, the 5 steps. There are critical things you've got to get right, and you've got to get that right to almost a meticulous level. What's the core team and their commitment? The story around that is the hardship along the way. Lead with customers and channels. We don't tend to focus on the customer, and we don't think to think in terms of a channel. Few people can go to the customer alone. You've got to have a channel partner. We'll talk about that in a moment. Using strategic partnerships, collaboration, in order to get to market and be part of a small cohort of people in that very narrow sector. Raising enough cash. 70% of businesses fail along the way because they run out of cash and they don't have a plan B. And then finally, the numbers. How do you measure the numbers? How do you take decisions, strategic decisions, that make sense from a gross margin or a return on investment, so that one thinks also like an investor with one's investment propositions. So to kick off on the first, this is 20 minutes of going through what the ground rules are and how it works. First of all, you're entrepreneurs and you want a business to grow, but what's the reason behind it? Is it to make money? Is it to dominate a sector? Is it to prove something in the past? What is the core reason to actually grow that business, and why should the team lock together? Usually it's human, usually it's passion driven, usually there's a few people in it who have the conviction and the endurance to drive the whole thing, and it's a mixture of different characters in the team. So it's really important. The reasons are critical, and there is an exploration required of the mindset of the people who are doing this. What is underlying this to drive them? So when the going gets really rough, as it will from time to time, that these team will stay together and be loyal to each other. So what's the story around that? What was the beginning? Usually if there's hardship, that's really good. Scaling. Is there a clear business model? A lot is not understood about scaling. One has deep intellectual property or revenue, or both, but usually there's one or the other. So deep intellectual property like the medical technology, medtech business means there's limited revenue for a long time, but traction is being established with customers and channels and research, and that's really important. The opposite is in the more IT, cyberspace, AI space, where revenue can be generated, and that is typically a monthly or annual recurring revenue. Really sweet. The important thing is to understand what it is and how clear it is. Finding sticky customers, that's customers who you can upsell into and also work on retention so that the monthly recurring revenue becomes annual recurring revenue, so that a customer is a lifetime commitment. Therefore, the ability to cut the net customer acquisition cost over time. So as one grows, the cost of acquiring a customer reduces because the customer stays with you, or the revenue within a customer globally or in country can be expanded. So rising recurring revenue from the customer, the channel, we can look at both. Channels lead to customers, but it must be recurring. So therefore, the rising value to everything that's being acquired all the time. So it gets easier to do larger groups of customers and therefore larger revenue as time moves on. Little is understood about that scaling from people, and so excuse us for that. So move to the next slide, Kadeem, please. The team. Is it a team? Sometimes by doing psychological assessment, one can test that. Why is it together? Is it just there to go for the gig? Or is there a deeper loyalty, a deeper friendship, a deeper trust, or some historic background that drives the team together? Sometimes a bit of testing. It's useful to test the team to see how a loyalty pervades over time, because that's what investors will do. They look at the team and see who's together and is it a team. Quite a lot of teams we find are dysfunctional, and they're only there for the party. They're not there for the end game. So persistence, endurance, passion, all those things come out. And a team is a mixture of people. It's not all the same type of person. So look at your team. Teams work. Individuals alone, it's much, much harder, and it carries much higher risk because a team can compensate for each other by the diversity. So think also diversity. Ready? So an example here, Damien McGoffin, a client of ours, compliance and risk. He built a business. He was in Brussels. He built a business out of Brussels. He's a lawyer. He had this passion to build a business that would provide compliance resources for major corporations. He did that progressively over the years and has now got a monthly recurring business with all the major electronic companies in the world, providing them services around compliance and risk review. And so he's done that the hard way, step by step, building a team with his family at one stage and then outside. Now he's got an outside chairman. But it's a very slow process. It's built on trust. One makes some mistakes, but one has to recover from them and then build up. So it's vital along the way that you have some wingmen, some people to work with you to give you that guidance. Thank you. Another example of how we do it, there's a security accelerator here in this building that we operate. It's in the cyber, AI, blockchain space. We select companies from around the world. We pull them together. We get them to knit together so that in technology terms, one compensates for the other in technology. And the learnings are shared as they go to market. So it's about surgical implementation of market entry and actually getting rid of the clutter that stops you doing that. Very successful to date, and thank you, Kareem. Oh no, we'll skip the video if we may. In the next slide. That's it. Perfect. Okay, so areas, zones. Think about sector. Fintech, regular. So the narrower one goes in sector, or focus the better usually, rather being all things to all people. When one does that, one can then focus on an application, one can focus on a channel, and one can focus on a customer. So think in terms of what is really mission critical in that sector, and how is your solution going to be really, really important. Generally, you're not unique, and that's good. Second or third in the market is good. Having competition is good. When somebody says there is no competition, it's worrying. There is always competition. So being able to disrupt competition and disrupt existing applications, really important. So think in terms of doing stuff outside the box, and that's the value that you have to bring to an investor. So in going to a Series A investor, what is different? What's unique? What is disruptive? How is it scalable from an economic viewpoint? All those things are really important. So commitment, how do you test commitment? Teams work, individuals generally don't. You've got to have a technical person in the team. You can't, in our opinion, you can't enter a high-tech business without one of the founders being really technical and being core to the whole thing. And then you've got to obviously go down, in the case of the Accelerator, beta customers, MVPs, etc., etc. The website is isa.corkbic.com, just to give you a little flavor of mindsets. Thank you, Bree. So lead with channels, customers. So often we don't do that. We lead with technology. Technology looking for a market, technology looking for a customer. Really not very good for raising money. So flip it. Think about customer, think about channel. That customer could be an acquisition customer, if not, but generally along the way it has to purchase things on a proof of concept and then go into regular production. Anticipate a long relationship with those customers, and therefore building the revenue in that customer, building the revenue, expanding the scope about work within that customer, and also really plotting on having a high retention. Ideally identify your core competences, and within that, again, be able to convince the investor, and also the customer for that matter, on your strategic intent and focus. The best companies are the ones that have a very, very clear strategic intent. They can articulate in a couple of sentences, and they focus. You can see it in their eyes. Ready? Could you change the slide, Perry?
Yes, sorry, Michael, just a second. We have a technical problem.
Okay, I'll just roll on, and without getting locked on the slides. The third is using strategic partnerships and collaborations. Your mindset needs to exist beyond your internal business. And the partnerships and collaborations need to exist outside of the business. So think in terms of actually putting something back. Think in terms of establishing collaborations that actually expand what you're doing a little bit. So one is narrow in the route to market. The other is consider partnerships that are expanding your operations, and the combination of the two can be quite powerful. So build a network. You don't know when you will need the network. Build a network with partners, tech providers, service providers, channel partners that know you and that you're linked to, so that at a time when you need them, you can go to them. So build the network when you don't need it. So therefore, when you do need it, it's already established and you're part of the infrastructure. And in that role, you can play a key node in that network. So you've got to work slightly outside the box at the same time as focusing. So the alliance considerations when looking for an alliance partner. Usually there's greater uncertainty and ambiguity around that. The methods of creating value are open. The evolution of relationships is very hard to predict. So it's high uncertainty. Where a technical person, it's really difficult to do. So sometimes one has to, it's not transactional because of the ambiguity and uncertainty, and managing the relationship is critical. So the initial agreements in these type of strategic relationships are not important. There's no joint venture relationship. It might be a memorandum of understanding, and it has to be built around common gains. There has to be a sharing, there has to be mutual collaboration, and their value, joint value, has to be created. If that value can be created in one form or another, then it can be shared. And small companies and large companies can build those relationships very easily, simply because a small company can do things that a big company can't. It can be agile, it can cross political boundaries, it can do lots of work very quickly for the larger company, and vice versa, and can be trusted because it's non-threatening to a variety of companies within a network. So small companies have really strategic considerations, and they sometimes use them, but not enough. They go into transactional mode, not strategic alliance mode. And the thing that adds value to an investor is where you have strategic alliances with major companies. So moving to great teams, which is the next slide, they're challenged by disruption. Prior failures and all kinds of learning become their bedrock and ground rules, and they can share those experiences. The endurance becomes important. They actually love that environment. So the critical thing is build a team that can actually have that persistence and endurance. And immediately the investor looks at this and says, these guys are low risk. The ability to learn and change. The great companies that can grow are the ones that can learn and then change when it doesn't work, and do that overnight. So pivoting can happen, and whereas everybody talks about this, but very rarely does it really work. And then leverage the tech competencies in the company and mind the tech team. Quite often we see dysfunction where the technical team of the company is not minded and looked after. And as a result of that, they're isolated, whereas they should be core to the whole development of the company, because their input can actually change the direction of the company. Step 4, raising enough cash. Critical to keep it simple. There are many sources, friends, family, some of you you've done that already. Business angels, very important for the very early stage. And also for the second stage or Series A, having a business angel component in the recent Series A rounds that we've been involved in is really important. It might only be 10 or 20% of the total round, but it gives credibility. It gives external credibility to the VC or the serious fund that is putting money into this business. So it's very welcome, and it's very important to have them on board. And also, not to be forgotten, is public co-funding at the EU level, at the government level, and at the region level. And some of these are tax-based schemes, which also are very attractive. So getting the public sector funding involved is really important. Sometimes it's softer than hardcore investment funding. VC, high growth, really important, and it's very important to get into that VC route. A Series A VC round will lead to a Series B VC round. And of course, don't forget customers. We always talk about raising funding, but we don't think about raising funding from customers, from transactions. I'm not thinking of investment funding now, I'm thinking of customer revenue. A customer revenue is worth many times an investor revenue, simply because it's more valuable and creates more credibility. So go for customers first, go for customer revenue first, and then build on the back of that the investor revenue or investment. So again, well-prepared business plans, the whole classic thing, you all know about that because many of you have raised initial funding. So what to do with scaling funds? What an investor will ask for? What do you want to use the money for? Is it a quick fix or is it a strategic investment? What happens is it's often raised for strategic investment, but is used for quick fixes. Not good. Operations versus development. Operations should fund themselves. Development is the new kid on the block, and that needs the strategic investment funding. And then the critical thing is to know how much is being generated in cash terms from customer profitability, so that in looking forward with a request or an offer for Series A, how much of that is going to be used for working capital, how much of it is going to be used to fund losses that are unforeseen, and how much of it is going to be used for R&D, which produces future return. And being able to have a very clear view of that and measure how that goes quarter by quarter is really important. So the use of scaling funds, to have a really clear position on that and have it linked into the financials. So finally, the numbers. Critical things take every day or every month, one's taking an investment decision, whether featuring a product, a new product, a new channel, new customer. Every quotation, every proposition is an investment decision. If you win and get lucky, it has implications. And so it's pretty vital that one understands not sales revenue, but gross margin or gross profit after non-recurring engineering goes in. So many people go and take an order with poor profitability, or after the NRE cost, there's poor profit in it. And it doesn't lead on to scaling business. So they get stuck. So it's pretty vital to look at the uplift and look at the potential for margin improvement in this. And what is high-tech business should be talking about 60, 70, 80, 90, 95% gross margin. If it's low, there's serious questions there. And likewise, proof of concepts that are free, that creates a load of problems as well. The critical thing is to get customer engagement and therefore focus on generating gross margin based on real sales, or gross profit based on real sales. So think about in terms of as things grow, customer, channel, region over time, focus. Don't diversify. Don't, if you're selling in the German market with a particular customer channel, don't suddenly diversify to Australia because it just comes in as a bluebird over the horizon. Focus. So return to the cost of acquiring a customer, the cost of acquiring a channel. Understand those numbers and therefore the ROI in that, because one only has so much investment funds and therefore one has to make it work and make it sweat. So look at rising gross margin and gross profit over time by customer and channel. That's the revenue enhancement we talked about earlier. And also from the point of view of investment decisions and feature decisions and channel decisions, to think in terms of what is the cash multiplier, what is the cash return. If it's break even, there's not really a business being built there. So it has to move on. And so it's that leveraging of investment, that leveraging of gross margin that's really important. If we can do that, you can start then on the back of that increased margin, employ more people, get more resources, and actually grow the business, and you have a scaling business. If you can explain that to an investor, that's very attractive. So customer revenue is the biggest leverage for an investor to move into a Series A decision-making mode. Good. So finally, what are the major lessons? This is from clients. Step back from all this. The CEO is a perpetual student in all areas. So in going into business, things develop, and in that there is a learning of things going wrong, learning of things going right. As a result of that, the CEO becomes sharper. You need a business partner with the CEO or with the founding team, otherwise the folks will crack up. A bad hire, if you hire in your very early stages the wrong person, it will cost you years. Very expensive to do if it's at senior level. Sales execution is all about the product, and that product could be software as a service, but it's a product. And marketing positioning is absolutely critical. So when you look at companies as they grow through Series A, Series B, their focus is on this, refining the engine, refining the team, refining the decision making, learning from what went right, what went wrong, and then capitalizing on what went right, and communicating and sharing that. Including in that is a pricing review model every 6 months. Most startup companies, scaling companies, leave money on the table because they don't review their pricing and they don't enhance it, or they don't increase it in a lot of cases. So analyze, 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 and have that open dialogue with yourselves and with other people as you go along. So moving to our next,
Michael, your guest speaker is there in the room. So...
Fantastic. So may I introduce Alan Veachner, CEO of Altada, who operates in the artificial intelligence space and has high growth and many years experience in startup firms. Alan, for you.
Hi everybody. Can you hear me okay, Mike?
Yes.
Indeed.
Good afternoon, everybody. Mike, yeah, fascinating lesson learned as always. So I guess I'll just start with the narrative of where we started, where we're going to, and the kind of what I refer to as bumps along the way. I'm happy to take any questions. I can't see the questions coming up, Mike, so maybe you can filter them to me or something.
Yeah, we'll tell us your story first. We have 10 minutes with you, Alan, and then we're going to go to Q&A, and then we're getting a variety of questions coming in already. So Pauline will be screening some of those as well.
I have multiple stories, but I guess I'll start with the one that's relevant to what we're discussing today. So the backstory is we started in 2017, and our addressable market was or is the data privacy space, which in essence is GDPR and the incoming US regulation CCPA. We quite quickly found that we found ourselves in a very strategic position in terms of attention we were receiving from a number of different avenues around funding, investors, and I guess AI and machine learning is a cool space. So it's we were not short of conversations with funders and people that were potentially going to invest. So that sounded extremely exciting. And I guess we got caught up in the believing your own story hype, and that's kind of my first lesson. Lesson number one is when you are entering into a situation of funding and fundraise, ensure that you're not getting caught up in your own hype and you don't believe the hype as they say, and ensure that you're firstly speaking with the right person within an organization, albeit a angel fund or private equity or VC or whatever the configuration is. Secondly, most importantly, is ensure that you can work with the individuals. And the third one, which is the most important thing, is to ensure the paperwork is in place. And I'll get back to that in a moment. So we successfully raised what we thought on paper enough funding to keep us going for 2 years of research and development. So we started to scale really quickly. Within 12 months, we had gone from a team of one and two founders really, but one in the tech division, which was myself, to a team of 22 data scientists and other developers supporting us in terms of front end, back end, the usual good stuff. So we had a team of 24, 32 if you're to count contractors. So we had gone through a serious growth spurt, and basically within that kind of growth spurt, this is where we found ourselves with the underwriting or the kind of overarching issue with a partnership with a funding or investor. And what I mean by that is, if you encounter an investor that is extremely excited about you scaling or very motivated to see you to ramp up, that's where you would start questioning in the logic and start pushing on what does that mean for you and what is the detail that sits behind that. So as we started to scale, we started to raise more and more money on a drip feed or a drip fed perspective. What I mean by that is, yes, we had line of sight of 1.5 million. Yes, we were scaling quickly. We were developing lots of projects, products. We had a lot of excitement around our product range. We had multiple requests for POCs, partnerships with larger organizations, and we started to secure proof of concept projects. What we didn't do, or what I didn't do, and what our team at the time didn't do, was ensure that as the investment came in, there was a valuation that was linked to that money in terms of what did that mean to the business, what did it mean to the founding members, and what did it mean in terms of stability. So that would be rule number one. So what I would always suggest in doing is map out exactly what you're looking for at the start. And what I mean by that is you just write it down. Write down your shareholding, your expectation, what shareholding looks like, expectation, what a cap table looks like, shareholder agreements to back that up with, it can be as rigorous or as simple as you want it to be, but make sure it's written down. And make sure that everybody buys into it, including the person that's putting in the money. Most importantly, the person that's putting in the money. That you set the expectation from the offset. Okay. As we scaled up, we started to identify new areas of interest, new addressable markets. This would then incur obviously more cost. Route to market, sales and marketing strategies, all that good stuff. This would entail a deeper level of investment and a funding partner that shared your vision. Okay. I guess the misstep from our perspective is when you start to work with investors, you need to understand what their expectations in terms of a return on investment. Are they in for the long haul? Are they just looking for a quick exit? Do they support your vision as a founding member? So I would go as far as to say, treat an incoming investor as if you were hiring a C-level executive in your business, and put them through the same rigorous due diligence as if you were hiring somebody into your company. And what I mean by that is qualify previous investments, qualify them as an investor. Or do they understand the space? Do they have domain expertise? Secondly, and importantly, do they have access to funding? You'd be quite surprised at the amount of investors that, yes, they have access to X amount of funding, but to go the extra mile with you, do they have access to that money, or do they need to get it from somewhere else? So, in terms of the qualification, ensure that the person you're dealing with is actually the person that's making the funding available, or is the actual investor, or are they part of a wider group, where you will find yourself in a situation that if the documentation is not in place to support your vision, you'll find yourself inheriting additional individuals into the business that may not be as friendly as the person that you built the relationship, or they might be friendlier and give you lots of money, and that comes at a price too. So ensure that you're always qualifying the cessation of the money, the origin of the money. The next part that is most important is when you're mapping your valuation, it has to be realistic. Don't overcommit. Do not overvalue. I know it's all fantastic to say you've got a $50 million business and you're getting money at a certain price. All that is doing is delaying the onset of the inevitable, which means that these guys are going to come back and look for more. So be as honest with them as you are to yourself, and ensure that the valuation you're getting is realistic. The targets you're setting are achievable. If not, you need to overpromise. I'd always underpromise, overdeliver if that's something you're in a position to do. Obviously, don't overinflate the valuation, because you'll just end up annoying or agitating an incoming investor money. And the last one is have respect for money that you're getting in. The money has a name, has a face to it, treat it as such. Ensure that you've got a good financial controller that's got your back, and map out as best as you can. Look, we all know that things don't go to plan, but make sure or ensure that you map out as best you can how the money is going to be used, and always look at it as forward momentum. It's not just to cover holes or cover costs or overheads, it's for forward momentum. The last one is ensuring that when you have mapped out how the money is being distributed, multiply by 3, because everything is going to take 3 times longer as a startup. Procurement, contracts, clients, engaging with larger businesses. Because you're a startup, it takes longer. That's just how it is. That's how it goes. And just if you build that into your plan, you won't have any surprises. The last one is, which is following on from that topic, is if you can fund your business or bankroll your business from client acquisition, you've got two tiers. One is proof of concept, usually either a deferred amount or some people do them for free. Frankly, I do not do proof of concepts for free because we have quite a lot of process behind onboarding and it's quite an intricate look at our technology. So a free POC to us is quite invasive. I would do a small sprint or a pilot that just shows that you can deliver what you're saying you can deliver, but a procrastinated demo should demonstrate that if you believe in your own product, depending on what your business looks like. But the most important thing is you've got proof of concept and proof of sale. These are two very different things. Proof of concept is, yes, it's a paid fee, it's a mate rate. Somebody will give you an X amount, usually undervalues you and undervalues your tool, but that's what you have to do to get to the next stage of development. You must get a few anchor clients. But once you get it to proof of sale, what I mean by proof of sale is you are charging upfront for your product because you believe that you will deliver a good solution or a good product to that client, and you're adding benefit. So do not be afraid to ask companies to put favorable procurement processes in place or favorable credit terms in place if they're backing you. Do not be afraid to ask for it. Everybody had to start somewhere, even the larger organizations. And if they can put you on a 60-day credit, they'll do it. If they can put you on a 90, they'll do that too, because they do not need to worry about your situation. You do. It's quite acceptable to ask them to pay up front or even pay a percentage of the overall project up front. This is gold dust, because essentially what's actually happening is your clients are becoming your investors. They're becoming your cash. And all too often, I hear a narrative, I'm going for exit, I'm going for 20 million valuation, I'm raising 3 million, I'm going to give away X amount of equity, but somewhere in the middle, we all are guilty of it. We forget that in the middle you have to build a business. And as you're building the business and raising money, there are two different hats. So the CEO has to wear two hats. You have to be the commercial director, you have to be the salesperson, you have to be business development, and you have to be the chief investment officer. And they're two very, very different gears. One is you're telling people about the vision, which is the investment side, and you're getting people to buy in. This is what we can do. This is what we can possibly do. And the other one is proving that you can do it and managing the detail, the finite detail of what it means to deliver a project or to deliver a solution.
Okay, Alan, thank you. Nice discussion. And I think you're right at it. So your current position is very relevant rather than taking somebody who did it 10 years ago or more. So it's live.
It's live, it's real, I've come through it. Yeah. Okay, Mike.
Okay, fantastic, thank you. And to just take some of the questions here that we've got online, I'll take one of them from Eduard. Your top three tips for customer loyalty. So let's wrap up. I'll give you more than three. While Alan was talking there, I thought about things. Get your tech guys to talk with the tech guys in the customer. Tech people in customers are really important. And if your tech guys have a relationship with those personally, that really makes it quite sticky, because then they communicate outside of the formal communication and it becomes interesting. That's one. Another is to identify critical events when the customer has a need. Something went wrong, supplier failed, they need to deliver something by a certain time and they need all hands on deck, and you can do it. One can build enormous loyalty by just doing that at a speed of response that no other person in the channel can do. And small companies can do that, often by working nights, often by working weekends to get the solution over the line. As a result of that, one becomes very important, and therefore the loyalty strengthens. Revenue share, if you can. In other words, in a deal, you split the revenue. There's often no logical way to do that, and it's overcomplicated to try and do it in cost. So generally reach a conclusion and then work on it, and it can always change. One can say this is a one-shot deal, go for that. And also deal with distributors of the customer, if one could do that also. And that builds the loyalty. So one becomes at multiple points of the operating arrangement, one is in there working, and therefore to actually remove you is very difficult. Also be listed on marketing material, and to have a profile or a name or see your product or service there in some way, shape or form. The last is probably jointly marketing in trade shows. Easy way to do that as a startup. They pay for the booth, they man it, they bring everybody there. You come to stand on the booth to help display the product, help sell it as part of the customer. And as a result, you're in the marketing team helping, and in a way that's not pushing your product, but pushing the joint arrangement between them. Those are ways to make you more sticky, as we call it, and build the customer loyalty. There was another question here about gross margins between hardware and software. What is good or acceptable gross margins? Here you've got to think about the gross margin is after the net sales. So a lot of people don't think about it. In a channel there is a distributor or a channel partner who gets a slice. The sales that you get as a company is net of that, and that's the only sale that's booked at the P&L level. So you've got to be fairly surgical about that. So then the gross margin we're talking about is the gross margin on the net sales, not the gross sales. And so therefore, in those net sales, what is good? Software, 80–90%. The numbers above that are any license fees you might pay for products, for things that you distribute within your software. And then on hardware, 50% or higher, depending on the richness and what is in the hardware. The ideal thing is to minimize hardware sales unless the margin is high, because it drags down your overall gross margin, and an overall lower gross margin is not attractive for scaling because a significant amount of revenue has to be put in to stock products, buy products, before they're ever sold to a customer. So one becomes like a shop where one has an inventory, and that inventory carries risk, because it carries risk because of technical obsolescence, and the right parts might be in or not in, and it also adds delay on shipments and delay on, and there's also warranties associated with the hardware. So hardware complicates it. But sometimes it's necessary. Some businesses are entirely hardware. The med tech business, joint implants, things like that, they're all hardware. But there are ways of minimizing that hardware where somebody else does it, and one has the core of the IP within that operating arrangement. So hardware is generally not good, but I'm not ruling it out. It just requires a different type of funding model and carries different risks. Are there any other questions that we could take here before we move? There's one other question here, which I won't jump into at the moment, but I'll read it. Is there any?
Yeah, please do type in your questions. We have 5 minutes left, so do not hesitate to type in your questions. Michael, to avoid making too many mistakes, would you recommend entrepreneurs to be involved in an incubator or an accelerator program? Is it something you feel is very important to access the right investors? What would you say about that?
I think to get investors, they don't happen by accident, and some investors are looking for disruptive companies. So think of yourself as disruptive. Are you disruptive? Are you mission critical? If not, tweak to make it so. There are more disruptive problems out there seeking solutions than there are solutions available. So that's the opportunity. So to find investors, they come through networks. So typically the good investors get references. It can be sometimes professional advisors like accountants. Trade shows are good. Conferences are good, but not too many of them. Winning awards and all this type of stuff is interesting, but it consumes a lot of time. So a little is good. The very good ones is good, but not too much. So the most important thing is to get into a network I was talking about earlier and be part of that network so that the key players in that network will refer you on to another source. And so therefore, in going to a VC or going to an investor, you would go in on the back of a reference from somebody else, rather than a resume over the wall, because VCs haven't got time, investors haven't got time to read multiple business plans. But one does need all of those toolkits to be in place for when the question comes and the ask comes and the invitation comes. So whether it should be incubator or accelerator, it depends what they are. It depends how much traction they can give you. It depends on the people leading it, their capability. It depends on whether they can access, whether they can bring in VCs into that, whether it has a track record. Incubator more so if there's a long route to market, such as in the biotech or medtech business. But there also is a time where you've got to get out of the lab and you've got to get into the market. And there's two views in that. One is delay, and so save the cost, and the other is do it quickly, take the hardship, but get to the customer route and the channel route quicker. And it's a balance between those. My view is go to market earlier, take those risks. Other people have different views of that. One can save money, but then not actually find alternate sources of funding. Private research money is good. Public research money is also good, so long as it doesn't tie you down too much and doesn't taint your IP, your intellectual property. Accelerators are really good if they, because they push you on and they make a quantum leap or not. I'm against accelerator tourism, whereby people go from one accelerator to another accelerator to another accelerator, but don't actually improve over 3 years. You've got to go for it, full on, and then you're the new kid on the block, and as a result of that, investors get interested. If you've been around a long time, going around in circles, there's something problematical about that. So think about going into the wilderness, think about being the hermit, spending very little, develop your product up, go to market with it, and then start widening that out very quickly.
Okay, thank you. I think we're going to wrap. Yeah, it's very interesting, everything. Thank you to Michael for all the insights and expertise. Thank you to Alan. Thank you to everybody for joining the event. We have to keep them, unfortunately, very short. We have 1 hour. You can see them again on our platform. We have online classes dedicated to these subjects as well, so don't hesitate to go to our website. Please answer our survey so we know what you thought about the event and we can keep improving. I wish you all a very good afternoon. Thank you, everybody.
Thank you, Pari. Thank you, everybody.